Hello and good evening, everybody. Thank you for joining us today. So today we are talking all about how should you manage your portfolio when you're investing using a Cancelim type of system. How many stocks should you own? How should you gradually build up your position? And a little bit about money management is what we're talking about today. Uh, as usual, before we get into today's topic, we will be having a little bit of an overview about the Indian market. Uh, my name is Arun, and joining me today is Raghav. And before we start with the topic, please go through this disclaimer. Uh, so, any of the examples that you might see in the presentation should not be taken as a buy or sell recommendation. It is just that we are trying to teach a certain methodology here, and hopefully, you will be able to use that during your own research. So, moving on to the market commentary.
Good evening, everyone. Before we start with an interesting presentation today, I'd like to give an update on how Indian markets have fared in the last 2 weeks. The Sensex has almost remained flat. There's been no much change. Both the benchmark indices have remained flat. Like if you can see on the presentation, the Sensex has gained about 0.12%, while the Nifty has gained about 0.15%. There has been a drag in the markets in the past 2 weeks because of various global and as well as domestic events. So, firstly, coming to the domestic events, one of the major trigger for the markets was RBI's monetary policy meeting. So, as widely expected, RBI has retained the rates at 6.25%. That is the repo rate. They've retained it. They've made no changes to it. While they have decreased the statutory liquidity ratio by 50 basis points. So what this means is basically the RBI has given the banks more liquidity. They have reduced the statutory liquidity ratio. This will allow banks to lend more, and also this in turn might decrease interest rates marginally on lending. And coming to the interest rates, maybe RBI has not changed changed the repo rate because we know that going ahead, like next month, the government is going to launch GST taxation. So maybe RBI is going to wait to see how the economy reacts to a shift from normal taxation to GST taxation. And also now that the monsoon season has started, maybe RBI wanted to give some time and see how the monsoon season would fare. So, and that is when in the next meeting, we expect next meeting to be crucial because given the inflation rate and also the forecast for GDP, there should be some change in the interest rates in the next bi-monthly monetary policy meeting. So moving on to the global events that have affected markets, one major event that affected markets was UK general elections. So there's been a lot of hush-hush around this topic in the past week. Prime Minister Theresa May has called for a snap elections like 3 years before they were actually scheduled to be conducted. She was expecting to get a higher majority this time around so that she can pass on the Brexit negotiations easily. However, there was no clear majority. Actually, they lost their share, and they basically the parliament went for a hung parliament. So that has been an upset for the UK, and also this will be really tough for the new government, to pass on Brexit negotiations. So that is why we have seen in the last in the this week as well. This event happened on Friday. So in this week as well, we've seen Asian as well as global markets have been lying low now, and there has not been any much great movement. Even though markets have started well today morning, we've seen that markets quickly came back and they ended flat. So I think investors should be exercising some caution and look at correlate global and domestic events to the stocks and see which stock would benefit and invest accordingly. And moving to the future, like in the next couple of weeks, I think the major trigger would be the GST launch. So in July, the government is expecting to launch the GSP, so that will be a major event that investors have to look ahead for, because that is going to be a very big reform for India. So that is what markets will be really volatile around that time. So investors should exercise some caution for that. And also the ongoing US Federal Reserve policy meeting, that is today and tomorrow, the US Federal Reserve is going to decide on the interest rate, as widely expected by global markets. There's going to be some hike in the rate. That is because the inflation has hit low, and also the economy would revive in case they would do this. Moving on to the broader indices, Nifty mid cap and small cap indices have made a nice move in the last 2 weeks. In the last meet, we saw that both these indices have come under pressure. Like there's been a lot of the back to back, they have declined by 1% and more. So that has been a major setback for broader indices. However, in the past 2 weeks, they have made a good comeback. They have gained 3%, 3.2% and 3.82% respectively. Coming to our model portfolio, we have added 2 stocks to our portfolio while we have removed 1 stock. The current distribution day count on the Nifty is 2, whereas on Sensex it is 4. However, the underlying market looks really strong, and it is looking really positive. So investors can take new positions depending on strong fundamentals and technical aspects. Indian market condition remains in a confirmed uptrend. The next couple of weeks will be crucial for Indian markets because there's going to be a major reform, that is the GST taxation. So investors should look ahead for this and invest wisely.
Okay, thanks Raghav for the market summary. Let's move on to today's meat of the presentation. So today is all about a little bit about money management and how you should manage your portfolio. So mainly 3 broad topics we're covering today. So should you diversify or should you concentrate? Should you hold a portfolio of very diversified stocks, or should you have only very few stocks in your portfolio? So if so, then how many stocks should you own exactly? We'll talk a little bit about that. Of course, it's all up to you how you want to manage your portfolio, but we'll just go over a few broad guidelines today. And lastly, we'll talk about a few tips on managing your portfolio. This would mean how exactly do you decide how much of a position do you want in each stock, and how do you build up to reach that position. Okay, so should you diversify or should you concentrate? So first of all, diversification is definitely a sound thing to do. I think anybody who has studied portfolio management in any formal way will definitely say that you should, in fact, be diversifying your portfolio to get rid of any unsystematic risk that might be there. So unsystematic risk is something that is like see, if you have a large portfolio and it consists of only a few stocks, if something happens to any one particular company, not any industry specific thing, but a particular company, if something happens to it, then that would mean that you can have significant losses in that portfolio. But we take a little bit of cautious approach towards diversifying, because our belief is that a lot of investors actually end up over diversifying their portfolio uh, based on this kind of thinking. So one quote by William O'Neill is that the best results are usually achieved through concentration or by putting your eggs in a few baskets that you know well and watch them carefully. Now the important thing in this quote is probably the second half, putting your eggs in a few baskets that you know well and you are watching them carefully. Now that is where some people can get mistaken, where they might buy a few stocks but they are not very sure about, they are not very selective in which stocks they pick. So our approach is diversify based on different industry groups. So that would mean that if something bad happens to any particular industry suddenly, then you will be relatively safe. So like we mentioned in earlier presentations, the type of approach we have is we look at the leading industry groups, and within the leading industry groups we try to identify which are the best stocks, and these are the ones that we try to hold in the portfolio. Now that would mean that any given time there are only going to be a few leading industry groups. Uh, So only a few industry groups will have great industry group ranks. Out of these leading industries, there will be a few handful of stocks that are the best in that industry, based on earnings growth, based on ROEs, based on margins, based on whatever fundamental analysis that we have gone through in earlier presentations. So if we are doing that, then if we buy only the top few stocks from the top few industries, that would automatically mean that we have somewhat of a concentrated holding. So the way we see it is you should not be diversifying just for the sake of having a diversified portfolio. We diversify if we are able to see a few different industries with a few different top stocks, and those are the ones that we will have in the portfolio. Now, what happens if you over diversify the portfolio? Let's look at a few pitfalls that can happen if the portfolio is over diversified. First problem is the biggest gainers in terms of percentage gain may not be a big position in your portfolio, and hence it may not lead to a big movement in your portfolio even if you pick a big winning stock. So William O'Neill says that the objective with investing is that you should have one or two big winners and not dozens of small profits. So another issue that it relates to what I just said now. We are trying to own the leading stocks from the leading industry groups. Now, if that is what we are trying to do, then it does not make sense to have a huge number of stocks in your portfolio, because not all of them can be leading stocks, and not all of those industries can be the leading industries at any given point in time. So that would mean that if you have a lot of stocks in your portfolio, many of them are not ideal. Many of them are subpar stocks. They are not really the best of the best. Uh, so if that is the kind of diversification that you have, that is kind of it is kind of a hedge for not knowing which is the best of the best. That is what this quote says. Broad diversification is plainly and simply often a hedge for ignorance. So don't use diversification as a substitute for not knowing enough about any of the stocks that you're investing in. You should not take the approach that I see the stock breaking out, but I'm not too well versed about this company, so let's take a small position and then keep doing this for the next several breakouts. So what will happen is that you will have a huge number of stocks in your portfolio, and of course, since you did not do too much of in-depth analysis on each of those breakouts, it's not it's not sure that all of them are going to be the best leading stocks. So what will happen is that with a lot of subpar stocks, many of them will have say small percentage gains of say 5 to 6% if the market is supporting, and few of them by chance would be great winners, and that those few will lead to large percentage gains. But then again, since you bought so many stocks, the biggest winners are not going to be a huge part of your portfolio, so that would mean that your overall portfolio returns would not be so great. The third problem with over diversification is that if you are trying to get out of the market, it becomes a little more tricky. We mentioned earlier several times before that as a retail investor, one of the best advantages that we have is the ability to get in and to get out of the market relatively quickly compared to institutions. Uh, Now, if you have a huge number of stocks, yes, you can sell your entire portfolio in one day, but you are not going to blindly sell all your holdings, right? You need to study the charts, take a look at what is happening in each of them, try to see if they are exhibiting any warning signs, and then you come to a decision on whether to sell. So we've covered this in our presentation on how do you sell your positions, what is defensive selling, what is selling into strength, and what is selling into weakness. Now, if you remember that, we talked about the different signs that you should look for. What are the signs of weaknesses that you should see? Uh, how do you sell into strength? When do you spot that this is a good enough gain and I should be booking my profits at this time? So all that takes some monitoring and some analysis of your portfolio. Now, what will happen is that if you have a huge number of stocks, it becomes very difficult and very time consuming to do that kind of monitoring of your portfolio. Uh, Now, we also said that when the market turns and when a bull market turns into a bear market, many of the stocks will also start correcting. 3 of the 4 stocks will move along with the market. So if the market is starting to become weak, most of the stocks in the market will also start moving down. Now, when you are in that kind of situation in the market, again, it becomes difficult to analyze all your holdings and then come to a decision which to sell first and which to hold on to for a longer period of time. So this, I think this illustrates that if you have 20 stocks and the market is moving to a correction, say you want to sell off 80% of your portfolio and hold on to only the 20 which you think are able to sit, which you are comfortable sitting through in the market correction. So if you want to sell 80% of your portfolio, and if you have 20 stocks, you need to sell 16 stocks. Now, taking a look at 16 charts and then analyzing when is the right time to sell, and keeping track of all that, and keeping it in your head that where do I have to sell it, and then monitoring if whether it has reached the right time to sell, and then executing that trade, all that becomes very tedious if you have this kind of 20 stock portfolio. Now imagine if you had just 5 stocks in that portfolio, then you're just talking about 4 stocks if you want to sell everything, most of your holdings when the market is in a correction. Now, keeping track of 4 is a lot easier than keeping track of 16, right? So owning fewer stocks will allow you to make decisions quickly. It will allow you to analyze things more clearly without getting overwhelmed. And once you have done your analysis and you've made your decisions, it becomes easier to execute those trades as well. Okay, so going back to our methodology, how exactly do we pick stocks? We follow the CANSLIM methodology. So does it have superior earnings growth and other characteristics that CANSLIM looks for? Do we know what is driving the growth of that stock? Do we know why people are getting excited about it, or why investors are getting excited about it? Uh, can we say clearly why we should get excited about investing in that company? So this is the N factor that we're talking about, that we need to identify. Uh, what are the trends in that industry? Who are the competitors? Is this the best in that industry? Do they have the best return on equity? Do they have the best margins? Are their earnings growing faster than all the other peers in that industry? That is also something that we need to look at. Who owns that stock? Do great mutual funds, do the top performing mutual funds hold that stock? Is the institutional holding increasing or is it decreasing? So now you remember, all of these things are the factors that we need to look at before we come to a buy decision. So using our methodology, before we add anything to our portfolio, uh, these are all the things that we need to look for. It's basically, what I'm trying to say is that it's a huge checklist. So it's not easy to do an analysis and then add something to your portfolio. Now, can you afford to do this kind of analysis? And for each of the stock that you want to buy, if you want to buy 20 stocks and you're going to do this kind of analysis for 20 stocks, it's going to become very, very time consuming. But instead, if you focus on just a few, if you just look at which one has the best industry group rank, and within the industry which has the best EPS rank, and then pick out a few of them, and then do more in-depth research on those few, so that becomes a lot more easier. So that will also mean that if you have only a few stocks in your portfolio, it's more likely that you're going to know those few stocks better. So once you know them better, you have more conviction in holding that name. Once you have a good conviction, that means you are more comfortable in making your buy decisions and making your sell decisions. So it means you have more time to study the chart, you have more time to study the fundamentals and the story, and so on and so on. uh, Tracking is another big issue. So like we mentioned earlier, uh, it is not that we may not always buy our entire holding in one go. So we might buy an initial position and then add on to that once we feel that the stock is working out. So that is like pyramiding up is something that we do, which we have an example of that here as well today. And of course, spotting warning signs. So this comes to selling. If you're trying to spot weakness and then you're trying to sell based on weakness in that stock, how quickly can you spot warning signs in the chart, and how quickly can you lock in those gains? Now that again, it becomes difficult. Doing these things will become difficult if you are talking about a huge portfolio of 20 stocks or so. So here's an example of spotting weakness and selling early while not suffering too much of losses. So let's see the few warning signs that Dalmia Bharat showed. So this is a daily chart that this is the daily chart from November 2016, and let's look at some of the warning signs that this stock showed, and let's see how easy or how not so easy was how was it to spot these warning signs before it started a big correction. So first sign is here. It made a new high on low volume. So you can see that here the stock makes a new high, but it makes that high on low volume. And what happened following that? So that itself is one warning sign. Making a new high on low volumes is not very healthy. And what happened over the next 3 days? Over the next 3 days, there was some selling pressure. So the very next day was a big sell-off with very heavy selling volume, as you can see here. And it closed negative for the next 3 days as well. And it closed somewhere near the bottom of the range for each of the next 3 days. And even after that, the one day that it closed positive, it actually volumes were quite low on that day, and it again closed somewhere near the day's low, even though it closed positive. So what is this telling you? If you are observing this closely, it will tell you that there is probably not so much of demand for this stock at this price level. So it's making new high on low volume, and then it is selling off on heavy volume. So what that is telling you is that there are a lot of people who are waiting for these new price highs just to sell their holdings. So that's what's happening here quite clearly. If you were keenly observing this daily chart, you would be able to come and reach that kind of conclusion. Now the question is, will you able to come to that kind of conclusion if this was one of the 20 stocks that you own? If you're looking at a portfolio of 20 stocks, and how much time are you going to spend looking at the daily chart for each of them and try to analyze what has happened over the past few days and try to interpret what has happened over the past few days? That would not be very easy if you're talking about 20 stocks. But if this was one of your 4 holdings, then you would be very much aware of this action. This is what kind of action is happening in the daily chart. So here you can see what happened after that one day closing up on low volume. So the next day it sold off on very heavy volume, closed near the bottom of the day's range, and yeah, and the volume was quite heavy as well. So this is what happened after that. So after these 3 negative days, there was another 2 positive days. Again, volume were very low for those 2 positive days, if you notice in this chart. And then there was this kind of a big gap down followed. It went really low and then reversed and closed higher. But still, it did not actually manage to close positive. And just have a look at how low it went. So it went really low, in fact, broke below the 50-day moving average and then reversed and closed positive. But even in spite of that, it was still a gap down day where the day's high was actually still lower than the prior day's low. So this is actually a gap down day, and plus volumes were quite heavy. It is definitely above average, but if you compare it to the nearby positive days, this is a very heavy down day actually, in fact. So again, this is something that you will only spot if you are tracking this very closely. If you did not track this in an intraday basis, you probably would not have noticed the kind of low that it made intraday and then came back, then managed to close somewhere near the top, but still negative for the day and so on. So if you were just checking this every 2-3 days or every week, every weekend, you most likely would have missed this kind of action. So how do you track it closely? Tracking this closely is only possible if you have a limited number of stocks in your portfolio and you know them well, and you are convinced about them, and that's when you will be able to spot these kind of action. So here's your clear sell signal. So once you have this day, there's another day of positive close. Once again, it closes. So notice that over the past 6 or 7 trading days, there are only 3 days where it closed positive, and even in those 3 days, it actually closed somewhere near the day's low, and volume was very weak in all of those 3 days. So here is your breaking below the 50-day and closing below the 50-day is your first clear sell signal. So closing below the 50-day on heavy volume, and as well it closed near the day's low as well. So this would be one sign where we would Probably if we had this in our portfolio, we would probably get out of our entire position by this day at least. And in fact, you can see after that what happened. It actually uh, the uptrend actually reversed, and then it started moving in a downtrend. So you can see the percentage decline here. It's actually 32% decline in less than 4 weeks. So if we were watching this very keenly, this arrow here, this is the first area that we would have seen that something is going wrong, and we would have at least started reducing our position on this day. So one day making a new high on low volume, followed by 3 days of negative close with much higher volumes compared to the up days, and closing near the day's low as well. So this third day where it closes near the day's low and also has very heavy volume, uh, we would have spotted that if we were closely watching, then we would have spotted that first, and if not gotten out of our entire position, at least started reducing our position by that time. And definitely by the time it broke below the 50-day, you should be getting out of the entire holding. So now what would happen if you were not tracking it too closely, and you were just watching the 50-day, for example. So if you were just watching the 50-day, then you might have spotted it on this day only, and up to this point, you would still have your entire full position in that stock. And if you were lucky and you spotted it on this day and you sold your entire holdings, then that would be great. If not, if you spotted this breaking below the 50-day at the end of the day and you only got a chance to sell in the next day, then look what happened. Your losses would have gotten a lot worse. So you can see the kind of quick decline that it has after very few subtle kind of warning signals. So if you were tracking it very closely, you would have most likely started reducing here and then gotten out completely on this day when it closes below the 50-day. So if you were not tracking it very closely and it finally closes below the 50-day on one day, and you notice that only after the market closed, then you would be in trouble. You would have lost a lot of your profits by that time and by trying to sell in the next few days. So finally, the end of the story is there are two ways to look at it. One is you own a lot of stocks in your portfolio and spread the risk, or you hold a few quality stocks. Now, we very much advocate the second option here. Know your stocks well, find out which is the best of the best. Buy the top quality stocks, and once you've identified them, you bet big on them. So that's how you get that's how you get good overall returns for your portfolio. Remember, if you do this first option, diversifying or spreading the risk, one thing is, yes, your portfolio will be a lot less volatile, but that would also mean that if it is in a bull run, even then your portfolio would be a lot less volatile. Or what that means is that even if all the stocks are doing well, few of them will have 20-30% returns, while few of them will still have 5 to 6% returns, which is how it would be. Because if you have a huge portfolio, not all of them are going to be the best of the best stocks. Now, what that will mean is that 20 to 30% return that you have in a few good stocks, uh, that is going to get diluted because you only have a small position in those relative to the size of your portfolio. Of course, the one caveat here is that you need to watch your holdings carefully. So you need to track every day what all of them are, what all the stocks are doing. Like we saw in the prior examples, there can be very subtle early warning signs that you can spot as a sign of weakness, and then you can use that to start reducing your position before the stock actually breaks below support levels and so on. Uh, so keeping a close eye is what you need to do while having a concentrated portfolio. So here are just a few guidelines. Of course, this depends on what is your risk appetite and how exactly you want to go about it. But just some guidelines from our side about how you should structure your portfolio for any given size. Remember, the point is owning a lot of stocks will make it difficult to spot action happening in the markets. But you cannot have, but if you have too much of a position in one stock, and if it goes wrong, then you can get trapped as well. So given all that we talked about just now, so this is the kind of structure that we would suggest if you have a look at this table. So remember that it goes all over 50 lakhs and anything above 50 lakhs, we say don't hold anything more than 8 stocks. So however big your portfolio is, we always say you should not have anything more than 8 stocks. Again, that comes down to the idea that we are trying to own the best of the best in our portfolio. So the best of the best, we believe, is not going to be more than 8 stocks anyway. And that will make sure that if you do have the best of the best, and and one of them results in a 50% gain, that would automatically translate to a decent percentage gain for your overall portfolio as well. So this kind of limitation saying that you can't have more than 8, if you put this cap on your holdings, then that would automatically force you to have uh, the best quality stocks in your portfolio only. So some tips on how to manage things. We said not more than 8, however big it is. What do you do if you already own 8 and then you see another great good quality stock? In that case, what you should do is take a look at the kind of gains that you have had in the portfolio and sell the one that you think is the worst performing. So of course, while doing this, you will have to take holding period into account as well as what is the recent action in markets. So if you have 8 already and then you see something that still looks good, take a look at all your holdings. Try to identify which is the one that is not performing too good right now. So which is the one that has not much of momentum going on, uh, which is kind of consolidating. Maybe one of your stocks is actually forming a base, or one of your stocks is not forming a base, but it has been trading sideways for a few weeks now. Uh, Identify that, get rid of that, and then you add um, the new stock that you have identified. Now, this will automatically make you evaluate that new stock very thoroughly to make sure that is it actually better than the one that I am removing from your portfolio. So this kind of rule is the way that you will force yourself to make sure that you have only the quality stocks in your portfolio and not the somewhat inferior ones. You are completely avoiding them. Once again, never sell your top performers. We talked about this earlier as well. Uh, we mentioned that if the market is correcting and you want to get out of your stock position, you should first be selling your poor performing stocks, the ones that are consolidating, the ones where you don't have too much of percentage gain. Those are the ones that you should be selling first, and the ones that are the best, that have great momentum, that you have good gains on, you should be holding on to them for a longer period of time. So that is one thing. So again, once again, if you want to add something and you already have 8 stocks in your portfolio, you need to make sure you're selling one of them. So that will again, it makes sure you have a concentrated portfolio, and as a side effect, it makes sure that you are scrutinizing every stock very carefully before adding, and your portfolio consists of the best high quality names. Okay, so how do you build up your position in your portfolio? So it's not necessary that you have to buy the entire position in one day. How do we suggest doing that? So that's what we'll go through now. Uh, so imagine the size is 80,000 rupees, and you decided that you want to have not more than 4 stocks in the portfolio. So we always say that you need to, at least initially when you invest in a stock, you invest a fixed amount. So once you decide that you have 4 stocks, the target position for each one would be 20,000 rupees. So now how do you go about building this position, and what should you do after you've built up that position? So we'll talk about all that. Uh, Again, focus on the dollar amount. So 80,000, and if you decide on 4 stocks, what you need to keep in mind is that you have 20,000 as an initial position for each stock. So why the same dollar amount? Few reasons for that. One is that it becomes easier to compare. Now, if you bought for each stock that you buy and add to your portfolio, your initial investment was always 20,000. Then it becomes very easy to quickly compare all of your holdings and see which one is the most valuable, which one has given you the most return. So if you already know what the initial starting point was for each position, then you can very quickly, by looking at your portfolio, you can say which are your best stocks and which are your worst stocks. So again, this automatically makes sure that you focus on the dollar profit amount rather than the percentage gain. So you might have something in your portfolio that has a 50% gain, but if that is just 7-8% of your overall portfolio, that's not going to help actually. So you need to make sure that you're focusing on the amount of profit that you have when you're trying to evaluate your position. So even if you have like a huge position of 50% of your portfolio is in one stock, and that stock goes 5% down. So 5% down doesn't sound like much, but since it is such a big chunk of your portfolio, that can actually lead to your losses. That can actually eat away the gains that you have got from other stocks that may have actually much better percentage gains than this one. So again, focus on the dollar amount here, and that comes as a side effect of investing the same dollar amount in each initial position that you buy, each initial holding that you have. Okay, so how do we go about building up the 20,000 position? So we usually don't suggest buying the entire position in one shot. Now the reason is that again, Cancelim is always about probability. The idea is that we try to maximize our probability of gains while minimizing our probability of losses. Now building up the position this way also helps make sure that uh, we move towards that kind of an objective. So first buy might be 50% of the target 20,000 position. So first buy would be 10,000 rupees. This would be exactly when the stock breaks out. The day that it breaks out and closes above pivot and volume is supportive, and you've studied everything about the stock and you decide that this is one you need to have in your portfolio, uh, buy 50% of the position just as on the day it breaks out. So then you have your foot in the door once already. Second buy is when the stock is up 2 to 2.5% above that. So the stock has broken out, it starts moving up. This could be the next day or the next to next day. So why do we say this? This is because then you're kind of sure that this breakout is actually working out, and it's not that it's broken out and then it's immediately pulling back and the breakout is immediately failing. If that does happen, then you would not buy this. You would not make the second buy. So you bought it at the breakout, the stock immediately starts correcting. So you did not buy your entire position yet. So that way it's kind of protecting you. So your losses are not going to be as high as you it would have been if you had bought the entire 20,000 rupees at the time of the breakout. So again, this is all about probability and trying to protect ourselves, trying to increase the odds of having gains in the portfolio. So first buy of 10,000, 50% of the target position. Second buy of around 30 to 35% of the target position. So a little bit less than the first buy. Like we said, we are always pyramiding up here. And this is done after the stock has gone up a little bit from your initial ideal buy point. So it starts to work. So you add a little bit more to your position. And the final buy, which fills up your entire initial target position of 20,000, that is made after it goes up another 2 to 2.5%. So you notice here that we put our foot in the door initially, and once it starts working, we slowly build up to that 20,000 position. So by the time we made a final buy, we are already sure that this breakout is working and the stock is moving up from there. So I already see a question here which says that would you wait for the next chart pattern? No. So I'll show you a chart example here. Second buy is just when it's just that the breakout has just happened. You've put your foot in the door, and then you see that this breakout is actually working out. It could be the next day or the next to next day where the stock starts moving up. So that's when you make your second buy and your third buy and so on. So we'll have a look at the chart where it'll be a lot more clear. So here you can see VMart Retail, a daily chart as of December 2016. So here would be our initial buy position. Exactly when it breaks out, 577.4 is the breakout pivot price. Ideal buy point is anything above that. So as soon as it closes above 577.4, that's when we make our initial buy position. So what is our 5% range then? So our 5% above 577.4 is 606.2. So we have this range to play with. So within 0 to 5%, we need to decide whether we need to build up our position and reach our full initial position, or we need to or it starts to look like it's not going to work out that well, and then we kind of get out of our initial position. So we buy here, so you can see all the 3 buy points here. The first day is when you buy 50% of your initial position in one shot, and that's exactly on the day that it breaks out. So on the very next day, you see that the breakout actually starts to work. So it goes up again, closes near the day's high, and the volume is still very strong and very supportive. So on the second day itself, you can make your next buy, and so add another 6,000 at that time. And the very third day, it continues to move up, and by this time, you're very sure that yes, this breakout is going to work, and it's going to fetch good returns, and it's not going to go lower from here uh, anytime soon. So by the time it goes up 3 days on very heavy volume, you're like completely convinced and you're completely in. So by the time the third day comes by, you've already bought your complete initial position, and you have the conviction that since you waited 1 day and 2 day, so you're already sure that yes, this breakout is actually working out, and it's not like it's immediately pulling back. So here that's what says in this bubble here. We are minimizing our risk by adding shares as the breakout shows that it's starting to work. Okay, so like we mentioned, if we took an example 80,000 rupees portfolio, and then we decided that we'll have 4 stocks, so that would mean that each stock would be 25% of your portfolio, at least the initial position that we invest in. Now what that makes sure is that we are not getting too much invested in any one position. So if you have a great winner and that kind of shoots up and then it becomes a big part of your portfolio, that's great. But it's not that we are investing the bulk of our portfolio in any one stock as an initial buy position. So we've already decided that we are going to have this many stocks in our portfolio, and that would mean that our position is going to be so much. Each position is going to be so much percent of the total. So that's once we've decided that we are not going to exceed that percentage, whatever it is. So even if we are really convinced, we are not going to exceed that 25% or 20,000 rupees initial investment. So now you have a portfolio, it starts to work, you have a few big winners. So one of your big winners has gone up a lot and you want to add more to it. So how do you add more to it? The best way is move money from the weakest performers to your winning stock. So if you have a stock that you already hold and it's fetched good returns, and it starts breaking out of another base pattern, in that case, if you have some other position that is not working out too well, you might as well get out of that position and add it to this winning stock that is now breaking out again. But here you have to be a little bit careful. Once again, we are not chasing stocks here. We are buying only at the correct buy point. So our initial buy position is made within 0 to 5% of the pivot price. So within the first few days, we know whether the breakout is working or it's not working. And based on that, in the first few days, we've built up our position within that 0 to 5% range. And when do we add more to that position later on? Only at the correct buy point when it is breaking out from the next base pattern. Again, it's all about pyramiding up. We are buying fewer smaller position each time that we add more. So our initial buy is always the biggest, and as we add more, it is always less than the initial buy. That kind of makes sure that our overall cost basis does not shoot up too high, and even if the later stage breakouts fail, then we are still overall in profits on that stock. Of course, it's important to keep aware of what percentage of your portfolio is in the same industry. This is so our diversification is all about having a few of the best performing industries. So all of them might be different industries. A few of the best performing industries is what we should have in the portfolio. Not that one industry is performing really well so that we have 5 stocks all from the same industry. That's not. In that case, you're not really diversifying at all. So the kind of healthy diversification that we would say is look at a few top leading industries and then have the best from that particular industry. So that's how you diversify. So summary of what we did today. Fairly simple money management concepts, nothing too complicated. Uh, First of all, yes, you need to diversify, but the way to do it is you have a few stocks from the leading industries. We are not over diversifying. We don't have too many stocks from the same industry, as well as we don't have too many industries in the portfolio as well. The reason that we don't advocate owning a lot of stocks is because it can dilute your results. So if you have a lot of stocks and one of them goes 30% high, 40% high, it's not going to have too much of an effect on your portfolio because it's not going to be a big part of your portfolio in the first place. Buy a few stocks that you selected carefully. So do good research, identify which are the ones that you want to own. Once you've done that, you need to bet big on them. And then once you've bet big on them, we need to watch them closely to make sure that there are no signs of weakness. It's not making new highs on low volume. It's not selling off continuously for several days and closing near the bottom. Upside volume should be higher than downside volume. What that means is when it goes up, we want to see strong volumes, but when it pulls back, we want to see low volumes. So all these factors we need to keep a close watch, which is again possible when you have a relatively concentrated portfolio. Uh, so the idea of all this type of all doing all these exercises is that we want to hold on to a few big winners, and we don't want to have a lot of small profits. So we want to have the best of the best, and those will have good percentage gains, and that will automatically result in great gains for the portfolio instead. But if you have dozens of small profits, even if you have great gains, that's going to get divided by uh, so many different stocks, and then your overall portfolio gain is not going to be much. So we also talked about a few tips today. First of all, decide what the size of your portfolio is. By size, I mean how much are you willing to invest as a principal in the market. Once you've decided that, then you decide on how many stocks you own. So once you have decided on how many stocks you own, you know each position that you buy into, how much of your portfolio is that going to be? It could be 30%, 25%, or if you have 8 stocks, it could be 12.5%. So it's not going to be less than 12.5% in any case, however big the portfolio is. So we know what our initial position is in terms of what percentage of the portfolio. We establish positions over a few days time, not just in one day, because we want to make sure that when we spot a breakout and when we buy that, we want to make sure that it is actually going to work out. So that's why we wait one day to see that the stock is actually moving up from there, and then we'll slowly build onto that position. When we do that, it's always our initial buy is always going to be the biggest. So our guideline is you buy 50% of your initial position on the day of the breakout, and then once it starts to work out, you add the remaining add up to reach the remaining initial position in a span of a few days. And again, always start with the same dollar amount. It becomes easy to monitor, and it forces you to focus on the dollar amount of gain in your portfolio rather than percentage gain, because even if you have a huge percentage gain on a small holding, that again is not going to lead to big gains in your portfolio here. So that's about it for today. Fairly simple, basic, kind of common sense money management topics. In fact, if you look at any big portfolio manager, most of them will advocate this kind of thinking, where you research well and you decide which is the best stock, you decide on which are the best quality stocks, and then you bet big on those. That's how you really fetch great gains on any portfolio. That's how most of the big players do it, and that's how we would suggest that you do it as well. So that's all for today. Our next session will be talking about how to do post analysis. Again, a very important topic as well when you're actually investing in the market. We need to learn continuously from our mistakes, and not only our mistakes, but we need to learn from our successes as well. So we need to know what we did wrong and not repeat that, and we need to know what we did right and follow that as well. How to keep a good record of what we bought and what we sold, and how we can spot a few bad habits. So if you keep doing post analysis, you will spot that there are a few bad habits that you have. It could be chasing stocks as they move higher. It could be buying them above 5% from the pivot price. This is something that many people will do, where they see a stock breakout and then they see it move above 5%, and then they say, wow, this is a really good stock. I should have bought it initially itself. Let's buy now. But they don't realize that it's already extended, and in case of a pullback, they can actually get trapped. So a lot of habits, bad habits that you may not be aware in real time, but if you do a post analysis, all these things will come to light. So all that will be coming up in the next session. So we hope you stay tuned for that. So before ending today's topic, I'll just put up the summary slide once again, and I'll take a pause for questions. And if you have questions, you can type them in the chat and I'll try to answer them. It is true actually. In case of a breakout, there it is generally observed that there will be a kind of a pullback towards the pivot price. So what you would do in that case is you bought it at the breakout. The next day it goes up, so you added more to your position. Then it pulls back. So if you have not built up your entire position and then it pulls back, then that gives you a little bit of buffer time to kind of wait and see, let it reach back to that pivot price and then start moving up again, and then I'll build up my complete position. So that is one way. But if you have already built up your position and then it pulls back a bit, then yes, it will be you will be in losses in the second and third buys. But then you already have the confidence that it broke out and volumes were very strong over the next few days as well. So that's giving you the confidence that yes, this breakout is more likely to work than to fail. So on the other hand, if it breaks out and then it immediately starts to move lower, that kind of gives the hint that this breakout may not actually work at this time. So that is the objective here. So if over the next few days you observe that it is going up on high volume, then most likely it is going to continue doing that, even if it does pull back a bit. Okay, what if one has, this is a really good question. What if one has old investments in good stocks, say TCS and L&T, add or sit tight? So here what you need to do is have a look at that chart for that particular stock. See what it is doing right now. Now, if you see that it's moving sideways for several times or it is within a base, then like William O'Neill said before, the only good stock is a stock that goes up. So if it is not going up, then why are you holding on to that position? So you need to ask yourself that question. If it is just going sideways, then there is no point in having your capital tied up in that position. So it would make sense to sort of get out or at least reduce a little bit, and then as the stock breaks out once again, then you can always enter again. But that said, if you don't want to trade so frequently, then you should have a look at that chart and see, is this making a flat base? Is this making a cup with handle? Am I okay with sitting through a cup with handle given the kind of percentage gain that I have? If you are okay with sitting through that cup with handle, then there's nothing wrong with it. But generally what we suggest is, since it is consolidating, you might as well get out, and as it breaks out, you can always re-enter again. One more question. Okay, so this is a very tricky situation where you're kind of trapped and you don't really know what to do. So this is why we advocate the idea of pyramiding up. So if you're buying into a stock, then your first buy is always going to be the biggest, and then your subsequent buys are always going to be less than your initial buys, and that will make sure that your average cost price is not going too high. So even if your later buys are get underwater, overall you are still going to be in profits if you do this sort of pyramiding up strategy. And again, if it starts going down, this is something that you should be observing in the chart. So you should be invested in only a few stocks, and that would mean that you are able to, you have the energy to, both time and the energy to watch those closely, and that would mean that as soon as you see signs of weakness, you are slowly getting out of your position. So that's how you avoid these kind of situations where it's already 40% below your buy price. Okay, session on base counting, that I think we can get back. We can incorporate it in one of our future webinars. And okay, material on distribution days. If you could just write to us about that, then we'll be able to get back to you on those distribution days. I would say selling on strength is more effective, because that automatically means that you are actually making the most efficient possible use of the capital. So selling on strength would be, it goes up 25%, and then you sell it, and then you wait for the next breakout. So that would mean that whatever capital you're using, you are wherever you invest it, you're always investing in a stock that is going up. So that is the best way to do things. But the reason why I give the alternative of you can sell on weakness and you can hold on to a stock while it consolidates, provided you have enough gains, is that a lot of people are not very comfortable in trading very frequently. Many people are a little bit reluctant to trade so frequently, and they want to, it gives them a sort of satisfaction to sit on a position, and make sure. Tax can be another problem, where if you're holding it for a long time, then you obviously save some tax on that stock. So it depends on your risk appetite, whether you're willing to trade frequently. Um, are you ready to monitor the stocks that you got out of? Say you bought a stock, it's given gains for you, then you sold it at 25%. Now you need to monitor that to make sure that is it giving you a chance to enter it again. Many people might not have the time to do that kind of thing. So in such kind of situations, it might be better to hold on for a bit longer period of time and sell on weakness. Okay, when it breaks out, it goes down for the next 2 or 3 sessions. In that case, you should not be adding more. So that is kind of telling you that this breakout is not working so well as of now. So what you should do is, you've bought your initial 50% of your initial position, and it starts going down over the next few days. Now you should not be thinking of buying more. You should be thinking, does it look like it's going to come back? Now, how do you say that? If it is selling on lower volume, there could be a chance that it is going to come back soon. So when it comes back, then you add to your position. Now, if it is selling on heavier volume, now that should make you think that this breakout is not going to work, and you should probably get out of your initial position. So then you should be thinking about when you should be getting out. Okay, thanks everybody for joining us. We hope you liked today's session. So, and we hope you stay tuned for the next one as well, which will be about how to do a post analysis. Thank you for joining us once again, and have a nice evening.